Okay, welcome everyone. Thanks for coming out this evening. Get ourselves underway right now. Okay, so if you've got a pen and paper and a calculator, not that important, but if you've got one, would help out. This webinar has been put together by FP Markets as a way of improving their clients' performance. As everyone's aware, the attrition rate in retail trading is extremely high. People come, spend their money and go again, and FP Markets are in a position where they make no money out of other people's losses. The company doesn't operate that way. That's not their business model. So the way of building FP Markets business is to have the clients achieve what they need to achieve in the market, and that works for FP and the client as well. So this webinar is part of a series that we're doing this year on advancing the clients. So I need to start with the disclaimer. This is educational material prepared for general guidance only, does not constitute financial product advice. It doesn't take into account your investment objectives, financial situation, or particular needs. And you must contact a licensed advisor before acting on any information. So we'll get ourselves underway. Thank you again for coming out. We'll take about 50 minutes. We'll get to some charts at the end and kick around a couple of trading ideas. Everyone would have received an email this morning with a Word document in there, and I'll get to that Word document as we go. I've got it on the screen here as well, so we can work at it from there. Okay, underway. So the markets, 101, the markets are made up of thousands of participants around the globe, both individual and corporate, each acting for their own reasons. That's essentially what makes the market, as everyone's aware of that. It's those individual needs. The corporates aren't going to tell you what they're going to do any more than the retail trader down the road is going to tell you what they're going to do, any more than someone in another country is going to tell you what they're going to do. And our market is looked at around the globe, and people make decisions based on their own reasoning at the time, and it shows up in price movement. The decision made by these participants shows up in the price movements of the individual shares. Here's the thing, the market is not a conspiracy theory. There is no conspiracy theory inside the stock market. The market works quite efficiently. People think that the markets can be moved. No, they can't. For example, the S&P 500 is valued at something like $15 trillion. You can't move that. You can move individual stocks for a short time, for a day or so, but essentially, and you need some fairly deep pockets to do that, but the market is not a conspiracy theory. New information comes to the market via media reports or company-specific media releases. Apple is a classic today. Apple released their earnings results at 7 a.m. this morning, and the markets will react to that information. So the information that individuals act on is based on their own decision making, and we do not know what is going to happen in the future. For example, I don't know what's going to happen in the future. A trading plan is required to give a response to the coming future movements in price. No one knows what they are. Hopefully they're in line with what we're thinking, but there are times when they're not. But those future, if you take a position in the market, those future movements are coming to you. And we need a rules or a guideline, a strong response to what those future price movements mean one way or the other. So prediction is not a trading plan. Predicting the market is not a trading plan. It simply doesn't work that way because there is too much information floating in and out of the market to make that type of assumption in the market at all. There is no such thing as a trade having a probability of working. Each individual trade is either 0 or 100%. It either works or it doesn't work. As simple as that. The degree at which it works is variable. The degree at which it loses is variable, but the trade itself, it either works or it doesn't work. It's either a positive or a negative at the end of the day. Many traders look for the next best thing, whether it's in the options market, or whether it's in the FX market or the futures market or the CFD leverage market or just the plain equities market, EFT markets, they all have the facility inside those markets to give you what you need out of the markets. There is no one better market than the other. What I do stress to you is whatever market you choose to work in, you take the time and learn everything you can about that market, about the way that that market works, all the way down to what hours it trades, where the exchanges are, who's involved, who are the big players involved, that type of thing. If you spend your life looking for the next best trading system, you'll spend your life looking for the next best trading system, and it will undo your long-term commitment to the markets. So we need to find a rule-based system, and on the real reasoning behind this here is on the FP Markets website, we've got a model portfolio up there which has produced about a 31% return over the last 5 months. And it has 3 rules in it, and it's very simple. Everyone can see it. Everyone can. All of the trades are documented on the portfolio, and I'll come to that in just a moment. A trader must know why a strategy makes money. You must understand why this strategy that you're working on is going to make money in the marketplace. And this is very simple back testing, and I mean very simple back testing. If you can print out the chart and just simply get a ruler and a pen on your desk, is easily as effective as back testing with computers over 10 million bars. Just understand why your strategy makes money. Simple back testing will suffice for that. It should be in sync with the market. The one thing that traders do need to understand is what stage the market is in. If you are a short-term trader, you need to understand the short-term ramifications of decisions on a day-to-day basis. If you are a longer-term trader, are we in a bullish phase in the market or a bearish phase in the market? This happens not only as far as an index goes, but also applies to individual stocks, specifically to individual stocks. In this Australian market at the moment, where we have the healthcare sector, the telecom sector outperforming the rest of the market by a mile, and that's where the opportunities lay. Trading with leverage and margin can be very effective or not. It cuts both ways, and we'll have a talk about that in a couple of moments. So trading with leverage and or margin can be very effective in the marketplace or not. And as you know, the FX market is leveraged, futures market is leveraged, our CFD market, of course, is leveraged, and options market is leveraged as well. If you take positions that are too big for your account, you will fail at trading. It has been proven over and over again over 100 years that if you take positions that are too big for your account, the market will, at some stage in your trading life, the market will move against you and you will fail at trading. It will take you out. If you trade out of emotional need like ego or revenge, you will fail at trading. This has also been proven over and over again. You will simply fail. Your money will stay here and off you'll go. It'll be in someone else's account. If you try and constantly catch a falling knife, you will fail at trading. This has also been proved over and over again. It's a simple rule to failure, this trying to catch a falling knife. You'll get it once or twice, think that you understand this, and then the next time will simply take you out because your position is also too large. If you double up on a falling price, you will fail at trading. This has also statistically proven. This is the one thing that takes out most traders, trying to bet against price movement itself. I saw it even today, people trying to short gold. When you fail, it looks like this. There are attributes inside trading that are not related to anything that we do in our daily lives. You must trade with a single thought, and that single thought is your trading plan. The single thought is getting your trading plan as sharp as you can to match the market conditions that you've got to work with and in the market that you're working with, of course. When you operate inside the stock market or any futures market, foreign exchange market, as human beings we are quite used to the idea that we can get our own way in life, and if something doesn't work for us, then we kind of ring people up or send emails, and until something works for us, get something to work for us. Over here on the top left is basically the trading paradigm, where we do some work, we do some investigation, then we take some action and place a trade or take a position in the market, and then along the way we monitor its progress. Is it doing as we expected? Is it not doing as we expected? Then ultimately, at some point, whether it's in a short time or a long time, we get the results and its implications. It's either stopped out, or we take profit, or we take it off the table because it's run out of time, or whatever it is. We get the result, the implications. And then comes the kicker, and then we ask ourselves, well, was the result as we expected? And there are only two answers to that. The answer is either yes or no. If the answer is yes, there is no action required, and we generally feel pretty good about ourselves. If the answer is no, we go back over here to the left and we go through this phase. How upset am I? How do I manipulate this outcome? Who didn't do their job? Where did I get the information? Who created this situation where I failed? What can I do? Who can I call, email, text, whatever? It's what we do normally in our lives, and for some reason people think that we can apply this to the market. The market is not interested. The market has already moved on and is basically producing the next trade that you need to be aware of. This is probably the most difficult area to get hold of as a trader, and let this part of in this part of your life, put this aside. I have trouble with this. I know a lot of people have trouble with this. It is something I consciously work at in my trading. I've seen many successful traders also struggle with this and put it aside, either through meditation or relaxation exercises, or some form of stress, some form of putting stress aside and moving on and looking for the next trade. The thing with the market is you need to believe that the next trade is coming. Now, it's okay to fail, and it's how you rise up that ultimately counts in the market. So why waste the time? If we monitor our thoughts and we find a path that's right for us, and this is where the work comes in. This is what they don't explain in educational workshops, is that the educational workshops are great. I've conducted a lot of them myself, but there is an individual path that is right for you. You can't take someone else's trading plan and apply it in your own life. It simply does. For some reason, it just doesn't work that way, because we think differently from everyone around us, and we have to create our own way of being with the market action itself. In the paperwork that you would have received, there was a small front page of that really starts out on the business plan of trading. And the first thing that we really need to get hold of are the running costs, the internet costs, the accounting costs, the data feed. Internet, of course, everyone has the internet in there, but whether you're paying for high-speed internet needs to be accounted for. The accounting part of it really relates also to superannuation funds. If you're trading through a superannuation fund, you must have that fund accounted and audited whether you make money or not, so that becomes a fixed cost of your trading business. And then there's the data feed, the selection of data feed, whether it's delayed data at about $30 a month, or full dynamic data at $100 plus a month. This is a running cost of the business. This is exactly the same thing as if you went to the bank and said, I'd like to borrow some money to do a business of some sort. They'd say, can you show us your cost analysis? This is your cost analysis. This is part of your cost analysis in this business. I also want to talk about the IRESS risk, a thing called IRESS risk, IRESS return. The risk management, how to quantify the risk management of a trading account. In the and I'll just very quickly go to on the website. On the website, we have a portfolio report that was updated yesterday. It's open, anyone can see it. I think you might need to register or something, but if you're a client, you'll see it anyway. It's in here under research, down here under Trader's Portfolio, and I update this every couple of days. and send it out if you're on the email list. Currently, it is as of yesterday was up 31% in 5 months, and I have a little note in here about what was added and taken away since the last time I sent the email out, and what's occurred in there. In the portfolio itself, what's occurred since November is we've taken about $24,000 in losses, and we've made profits of $55,500. What has really occurred in there is that we've had about 27 or 28 trades in there. Of about 23 of them, we've actually been just stopped out. The trade hasn't gone anywhere. Down the bottom, I'll skip down the bottom here. Down the bottom is a list of all of the stops taken, the date that they were closed. You can go back and look at them. A little bit above that is all of the rationale for the trade. For example, Retail Food Group, which was put in a couple of days ago. If you click on this little bit here, it will give you a snapshot of the entry point, and just down the bottom here is a little bit of thinking behind the trade, what I'm looking at, what I'm expecting, in some cases expecting to see. In this case, saw Retail Food Group pull back, it closed out the gap here, started to break out, and so we took a position. And that's all the way through every trade. Just above that, we have the open trades, the trades that are currently open, ones that are recently stopped, and then we have a series of closed trades down here. What's to notice here is that the closed trades, Telstra, we had a position in Telstra in December, we made $8,300. Capital Health, $10,500, and so on. Health Services, $1,200, and TPM, $9,700. Elders, ELD. So we have these nice returns, which took about anywhere from 4 to 6 weeks to get. But when you look down at the stops that were taken along the way, some of the trades we've been stopped out, and we've looked at a re-entry position, but the actual losses on the stops go into several $100s. The worst one here was TPM at one stage, but they're basically small losses compared to the trades that really worked for us, and I'll show you the outcome, how that outcome was. So in there's a basically set of trading rules here. $100,000 starting balance. In this case, and there are many cases around this is the bit that you really need to figure out and just write it down on a piece of paper. But in this case, I'm using a margin size of 5% of the balance. So the $100,000, I'm using $5,000 of margin per trade. So the example is that if BHP is trading at $33 a share, the current CFD margin is $1.66, so $5,000 divided by $1.66 gives me a position size of 3,013 CFDs. We monitor the portfolio so it does not exceed 60%. The margins don't exceed 60% of its value. We have a really simple strategy in there. This is the Retail Food Group trade. This is where traders need to go with their monitoring of and putting together a trading plan. This is the chart that we looked at just a moment ago, just updated with yesterday's price action. I think it's come a little lower today, but essentially the entry point is here at $7.16. That was our entry point on there. The stop loss in most cases is set at the low of the day before. So we're either stopped out very quickly or the trade gets underway. And this is proven to be a workable stop system. So entry price at $7.16, a stop at $6.80 gives us an immediate risk of 36 cents on the trade. Down the bottom here, and I'll come back to this a little bit more later, there's a CCI, Commodity Channel Index, and an RSI. both set at standard settings, CCI 20, RSI 14. On the CCI, as the confirmation for this entry point up here was not only the break out of this downward pattern, but it was also the fact that the CCI had crossed over 0 and that the RSI here was trading above 50. And if you go back, and we'll go to some charts in a moment, but if you go back into your trades, look at your successful trades, particularly unsuccessful trades on the long side of the market where you've bought a position, hasn't worked. Just have a look at where these two indicators were at the time of your trade entry. So in this particular example, this is pretty much how the portfolio is run. Looking for something interesting technically, and then our entry point with an immediate stop loss on the previous bar, and this is why we get stopped out a number of times. So if we say then that R, if this area here, the distance between our entry point and the distance to our stop point is 36 cents in this case, we'll call this our R, our risk. If R, the risk, is called 1, so we'll call that 1 unit, then whatever happens after that can be a factor of the risk. So for example, if in this particular situation, if R is 36 cents, so if the trade actually loses 36 cents and we get stopped out there, then we have an R value of minus 1R in this case. So again, if the R value is 36 cents, and if the trade goes ahead as we expect and makes a profit of 36 cents, then we have an R of 1, plus 1. So we've risked 36 cents to make 36 cents. So R becomes plus 1. Now, as things get underway, as we hope they do, if the trade, for example, makes a $2 profit, if things get underway over the next days and weeks and the trade makes a $2 profit, then that value of $2 is divided by the stop loss value, 36 cents, to give us our R return. In this case, $2 divided by 36 cents gives us 5.5. If the trade is closed out with a $2 profit, that means we have a 5.5 R return. A positive R return. Go through your trades, write down what your risk was and your return was as a value of R. Really simple thing to do. You can do it on a scrap piece of paper. If you have a positive R, this will lead to an expectancy of future trades. If you have a positive R as an outcome, if you backtest your trading plan, no matter what it is, and you end up with a positive R on there, then you have a positive expectancy of your trades. So your capital, starting capital of $100,000. If you're using just cash, and we take a position size of $5,000 or 5% of the account, becomes just a pure straight play into an equity. That position size is $5,000. In this case, at the time, RFG was $7.36. It would allow us to buy 679 units. Keep in mind R equals risk and also R equals return. The dollar value of the risk can be equated into the dollar value of the return, which we've just talked about. So if the stop is 36 cents, then the risk is $2,244. 679 units times 36 equals $244. Becomes a percentage of the count as 0.24. And then the return is, we don't know what the return is going to be in the future. But essentially, for every 36 cents of gain, the return equals 1. So a risk equals 1, the reward equals 1, so the risk reward can be 1, or it can be 2, or it can be 5, depending on the outcome. And the outcome at this stage is unknown. Now, very quickly, go back over this very quickly. We're looking at the initial stop loss. Find your trade. This is where my stop loss is going to be. And if you look through the portfolio on the website, you will find out that we have taken, I think off the top of my head, it's 28 trades in there, and we've been stopped out on nearly 3/4 of them, and the thing is up 31%. And it's based on this very simple, very simple methodology. So we look at where our stop is, set our stop in the market. That becomes our risk, and then as the trade goes forward, we end up with a multiple of our actual risk in the market. Now, this 36 cents will differ for every single trade that you take. It must be appropriate for what you deem responsible for your account. So again, position size $5,000, $7.36. We take 679 units. R equals risk, R equals return. So the stop is 36 cents equals a potential $244 loss becomes 0.24 of the account. And after that, we don't get stopped and the trade makes money, then we equate that as part of our 36 cents, our risk in there. If we're using margin in the account, let's go again. The margin size is $5,000 as a percentage of the account is 5%. But again, margin is a little different. With margin, we're going to use $5,000 of our account as our margin value. In this case, RFG was the margin on RFG is $1.06, so $1.06 per share against $7.36 of the actual value of the share. So we're margining the account. This allows us now to buy or to take up 4,716 units. Again, it's the same. R equals risk, R equals return. 4,716 units times our potential stop of 36 cents gives us a risk of $1,698. On the other side, on the upside, so that becomes our risk in there of $1,698, which becomes about 1.7% of our account value. Again, for every gain of 36 cents or part thereof, every gain becomes a return of 1. So if the trade got underway and moved the same amount as if we just bought the vanilla stock, we would a return of 1 would be $1,698 and it would be listed as 1. So risk equals 1, reward equals 1. So risk reward equals 1. Again, the outcome is unknown. And it looks like this. So initial risk of 36 cents becomes our R value, our risk value. It was, in this case, 1.7% of the account. If the trade gets underway and we make 72 cents profit out of the trade, our R return becomes 2. So we risk 1 to make 2. So in our actual return, we have an R2. You can draw this out on a piece of paper. You do not need to understand Excel or spreadsheets to do this. You just do it out on a piece of paper with a pen and a calculator, and it will give you a view, a context of where your trading is at. So again, down here, if the stock loses value, the stock goes down. We had potentially R2, but we're stopped at 36 cents. So we've hit our stop at 1,698. Our maximum R value is -1. As you work through your trades, you'll find that as you work this out as a reward against the risk that you took, the reward becomes a portion of the risk. As you work that out and you come down the bottom here and you end up with a positive R on there, you have a positive expectancy of an outcome. You can go a little further, and I've just simply added a couple of columns on here. Profit and losses, R expectancy, R2, R -1, and so on. And then you can put it into dollar figures at the end of the day. So that's essentially what a trading plan, how a trading plan should pan out in there. So let's take a look. In the paperwork that we've sent out to you is this. There's this Word document here. There is a bit of an intro there. Then we've got this just a space for fixed costs on there. The time that you want to spend working at this in the markets, whether you want to spend an hour a day or spend all day or spend an hour a week, whatever it is, write down your skills down here, what you're good at. The market doesn't actually care what you're good at, but just write down what you're good at. Particularly if you've left a workplace to do this. And again, down the bottom here is a further explanation of the risk and return, and risk can be equated as a percentage of the return and so on, so as the R value. So there's a little bit of example things to work through there. One thing there's just a little note here that volatility as risk can be calculated by an average range of 2 days. An ATR, average true range, gives you essentially a dollar value at the right-hand side of the screen. So in particular, if an ATR, for example, is 26 cents and the stock price is $5.60, then you can essentially have a 5% movement over 2 days. It's something a lot of traders aren't aware of, and I'll come back to this in a moment. But just have a look at the volatility of the stock, because we get these kind of blindside ideas about where something can go to without ever considering what the stock can actually do against us along the way. The plan. Write down 1 or 2 trading rules, and further down the document here there's a little bit of text about setting up a trading rule plan, but further down the document here there is a trading plan based around a fundamental view of the market, when you basically buy and sell shares or something on a fundamental view. And then there's three very simple rule-based trading systems at the bottom of inside the document. This guy here, this one here, and I really encourage you to put this to the test and see if this works for, like, you can see this in here. Very simply, looking at the price action with a 20-day moving average on your chart and a 50-day moving average on your chart. So the rule is that we're looking for a trading range, a daily range, that closes in the top 25% of the day. Down here we have this trading range here, this little consolidation, and then starting to break out here. It's gapped out, but the closing price for the day is in the top 25%. So we need to look at the market into the close in the last 10 minutes of the day. Is it closing the top 25%? Is it technically an interesting thing? Yes, this is my entry point. The stop loss is taken when the market trades below the pivot point low. So essentially the first stop comes in under that day, the second stop comes in under the next day. Every single day we move the stop up to the low of the day, and then in here we are stopped out very quickly before this sideways movement again. Again here, the same stock, it is above the 20-day average, above the 50-day average. It's closed in its high, coming out of this consolidation, and eventually we're stopped up in here. This type of short-term trading will give you a high expectancy outcome as a trading plan. You need to back test this. You need to make sure it works for you. You need to look at the characteristic of the stock. Can the stock give me 5 or 6 up days in a row? If you're looking at for example, Santos at the moment, you can't get 5 or 6 up days in a row, so that's not the stock to look at. Neither is Fortescue. So here you need to find something that is moving nicely, take the pressure off yourself, and just find the nice entry day. 2 very simple rules, and you can essentially write down your outcome with what your risk is going to be, your entry point, and your stop loss is the low of the first day, so you know immediately what your risk is, and you pop that up every day following your entry day in there. So the second little system is this one. We've talked about this a few moments ago. Again, it's a daily time frame. You need about an hour a day to kind of look at this. You buy and hold when the relative strength indicator, the RSI, is above 50. When the RSI ticks above 50 here and the commodity channel index CCI set at 20 is above 0. Those two items together give you the basis of a trading rule. Following that, you can look for the break, the day that breaks away from the congestion in there with these two behind you, and simply move your stop underneath the previous day, then the next day, and then the next day. In the example back in here, that's essentially what this is with our entry point. Our entry point up in here, the stop was set back here. The stop needs to come up every day until you're ultimately stopped out. You may get stopped out very quickly on some things, but other times they'll work in your favor on there. So that's, again, this is a rule-based trading system, very simple rules. And trading systems, this is the point of this exercise, is that trading systems don't need to be a page and a half long. They can be very simple. The price only does one thing. It goes up, down. That's all it does. And maybe sideways for a while, but essentially goes up or down. So that's there's some space at the bottom there. You can make some notes there. And the third system, the third rule-based system, again, you can look at a weekly chart and a daily time frame and also in a daily time frame, but essentially it's looking for a doji line where the markets have come down where we think it's a support level or something like that, and the market forms a doji candle, or a day where the opening price and closing price is almost the same. The entry point is when the market closes above the high of that doji day. So that becomes our entry line, and you can set an order at those sorts of levels that will take you up. Should the market trade back through that level, the order will get picked up, a stop buy order, and you get taken away with the market. So for this type of price movement, a stop should be set from the following price action. The first stop is set off the low of the doji signal. So there's the low down here of the doji signal. The stop is then moved up under the low of each trading period until you're stopped out. So it's essentially short-term trading, day-to-day trading. You need about an hour a day to make it work. In the methodology of that, this is Bluescope Steel. I just saw point out also, come back to this, down the bottom of the notes that you have, as I do in every single workshop that I do, every single talk I do, I talk about this. This methodology of trend is something really important that a lot of traders seem to want to step around here. That trend is only defined by price. There is no other way to define a trend. Trend is not defined by moving averages. Trend is not defined by a set of indicators. Trend is defined by price. It's in every textbook. It has been for 100 years. So as a market starts to move up here, makes a high, and then pulls back, and then makes a higher low and rallies out of there, when it breaks the high, and the little model here, where it breaks the high, that is the determination of trend. There is no other model for determining trend. And you can use this in any time frame you choose. Primary markets, we always refer to primary markets. When I say in here, this applies to both primary and secondary markets. The primary market is simply a weekly chart out in a bigger time frame, a weekly or a monthly chart. So when this pattern changes, you can determine then that the trend has changed. So down the bottom here is the opposite. Market makes a high, makes a low, then makes a lower high here, comes and breaks the previous low. There's the graphic up here. That is the determination of downtrend in the market. Bluescope Steel. Bluescope Steel, this is the weekly chart of Bluescope. We can see on the left-hand side here the market was trending up. the CCI was basically above 0, the RSI was basically above 50, and then it switched. Broke down below, CCI broke below 0, RSI broke down below 50. But as the market moved on over the next month or so, it formed a lower high here, came down, broke the low, formed a lower high, a lower low down here, then a lower high, then a higher low, but a lower high, and ultimately down here is a lower low. This is not the place to try and buy this type of stock. The CCI is below 0, RSI is down here at 30. This has not had a chance to recover itself and start to form a new trend. One that we did look at, it's in the up on the website. This New Farm stock has had this long sideways movement where it's had these sort of short rallies, short uptrend here, then the lower high formed and basically had a corrective move. But it comes off the back of this monster downtrend. Stock goes sideways in through here. And then suddenly at the bottom here we have this higher low here set off the March last year low, higher high, higher low, and now it's broken out through here, set a higher high out here, pulled back, and is currently looks to be setting a higher low at this stage. It's the best information we have. It looks to be setting a higher low where the buyers have come in with a full engulfing week last week on the candle. But more importantly is that the RSI has crossed back above 50 and the CCI is back above 0. It gives you high probability trades. This type of trading, if you just simply draw a line across the resistance area, look for the first up day where the market closes in the top 25% of the range outside of this consolidation, and simply set your stop underneath the low of every trading day in line with this model of trend. Here, this is our model of trend. This is uptrend, low, high, higher low, higher high, higher low. This is in the primary market, in the broader market. When you come down and look at this on an individual weekly basis, we have a low, a high, a higher low, a higher 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 high, a higher low, higher high, then lower high, lower low. There's your stop right there. So currently we've entered in a position here, and our stop is back here at $6.21, and looking for this trend to continue if these indicators remain positive. One thing that is in the portfolio that we got stopped on here is the Technology One. I'll show you on a daily chart, sorry. Technology One, monster uptrend on this stock. We got onto this at the break over here on the left hand side. Currently it has formed a lower high here on the right. We got back here at $4 or $3.39 or something on this break in here. It was still holding the position, but it has formed a lower high, and the CCI has crossed 0 and the RSI is down here below 50. It's an exit, simple as that. So when the next time the portfolio comes out, you'll see that taken out of there and at the appropriate time. So essentially, that's the methodology. You must have a trading plan that you can simply open up a chart and say, well, if my trading plan is I'm going to buy the doji, go back and have a look in the chart and say, does it actually work? So in here, there's this particular stock, there's a doji in there that produced a nice run up through here. Here's a doji here that would have produced a loss almost immediately, and here the gravestone, maybe count that as a doji, but there's nothing really in there. There's the doji there and produced a nice trade. So now I've got 2 trades out of 3 that actually work using the simple doji system. Here's a doji here after this consolidation, and so on. So backtesting is as simple as that. Don't make it any more complicated than that. It is really up to the market at the end of the day, and it's up to your management of the position at the end of the day based on whatever you write in here as your trading plan. So the the proof of the pudding is here in the portfolio. I really encourage you to have a look through it. We also, as part of the portfolio, I run a bit of commentary on the market, the index commentary. I leave all the past comments in. You can see what the thinking has been basically over a couple of weeks. This chart was put in yesterday when we were testing the 59.80 levels again on the index, and a bit of comment about the weekly chart in there as well. And then below that is this very simple little trading system with all of the trade entries, and down here the rationale. You simply click on the little sign there, and it gives you the chart, and gives you the commentary behind the thinking on the chart. This is a current position in Telstra at the moment, and we got in, I think, around $6.24 here. Was currently trading at the time, so it's we're still holding that position. So I would encourage you to take a look at that. I'm going to finish in just a few moments. I very quickly want to point out, this is my email address. You're more than welcome to email me. You're more than welcome to call the office and talk to me about it. If you've got a trading plan or you want some help with a trading plan, more than happy to do that. The whole idea of trading is not a competition with anybody else. It's really a competition with yourself. Don't call me if you haven't got a trading plan written down. There's no point, because we haven't got anywhere to start from. So write down something, and if you need some help with it, you're more than welcome to call or email me that trading plan. FP, for coming out and attending the webinar, FP are offering, open up here, FP are offering discounted brokerage accounts if you'd like to try this out. They also have demo accounts available on there. Just simply set one of those up off the website. But they're offering 9 basis points as your brokerage with no minimum trade value, trade size on new accounts. The only thing is down here in the fine print, it needs to be funded with $1,000 or more by the end of April. If you need any help with this, simply call the office and they will help you out with this, setting this up. So, and you can take the trading plans and you can bend them around a bit, or you can add to them, or simply write your own, but keep it very, very simple. You can use other indicators like stochastics or MACD, and simply scroll back in the charts and look and actually look, do they work against the market conditions at the time. This link here, I'll send this to everyone with the webinar software. I think I can. I'm going to have a go at in a second. If I send that to everyone, everyone should have that link now in their little webinar box under the chat window. If you have any questions about this, you're more than welcome to contact myself or us, any other questions about it. Also, very quickly point out that on the FP site, we run a Monday morning webinar at 9:30 in the morning, which is free to attend. It's a 30-minute update on the markets. It's very fast, go through a lot of things, gives you an insight into some analysis in there. During the course of this year, FP Markets will be running face-to-face technical analysis workshops. They'll be free. Just keep an eye out for those. We generally do them in the capital cities. They're there for a full day, no obligation, and free, and FP will be doing those as we go through the year. So have a good look around the website. On the website in here, there's also a thing called Newsfeed. You can simply click on the Newsfeed link here, and all of the waiting. all of the, here we go, all of the trade ideas that come through get put up through here, and there's pages of them, 20 or 30 pages of them. If you click on one of these, it opens it up with the chart and the rationale again, the rationale behind it. This was New Farm the other day. The breakpoint down here, this RSI, in this case the RSI CCI, giving a buy signal after a sell signal. This nice smooth action on the chart on here. So all of this happens in the newsfeed. It's free. You're more than welcome to look at that. You're more than welcome to send me comments on that. And there's a couple of comments here. This is something I think is going to matter in the bigger picture of the markets, worth keeping an eye out on. This went up a few days ago. The transports, the Dow Jones transports, are looking as bullish as the rest of the market. If there's a break, if there's a clear break on these transports below 8,600, we might be in for a short bearish stretch. And it hasn't happened yet, but it is. It'll give the market a bit of context as it goes. So all of those notes are there. They're free to everyone. Thank you again for coming out tonight. If you need any assistance at all, that's my email address. You're more than welcome to call the office, and they'll put you through. And I wish you good trading. Thank you.